Jake buys a rental property. Marcus invests the same amount of money into index funds. Both believe they made the smarter choice. But after 20 years, one of them will spend countless hours dealing with tenants, repairs, and unexpected problems, while the other will barely touch his investment. And here's the shocking part. When you include taxes, maintenance, vacancies, market crashes, and the value of their time, they end up much closer than most people expect. The question isn't who made more money. The question is whether the extra stress, risk, and effort were worth it. Let's find out. Jake and Marcus both start with $50,000 saved. They earn $55,000 a year. Same age, same city, same financial starting point. The only difference is what they do with that $50,000. Jake uses it as a 20% down payment on a $250,000 rental property. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit. Jake feels like a genius. Marcus takes the same $50,000 and invests it in a total stock market index fund. No leverage, no tenants, no mortgages, no late night phone calls. He also sets up an automatic contribution of $300 a month and forgets about it. When people ask what he's investing in, he says, index funds. Nobody is impressed. No exciting story, no property tours, no keys, no bragging rights, just a brokerage account. On day one, Jake has a house and a tenant. Marcus has a number on a screen. It feels like Jake is winning, but investing isn't about feelings. It's about math. For the first few years, Jake feels like a successful landlord. Every month, rent money arrives in his account. He drives past the property and thinks, I own that. He enjoys tax benefits and watches home prices slowly rise. Everything about the investment feels smart. Marcus has a different experience. He checks his account every few months. Sometimes it's up, sometimes it's down, nothing exciting happens. Year one, his $50,000 grows to around $55,000. Year two, around $61,000. The growth is real, but it doesn't feel exciting. There's no physical asset, no tenant, no proof that he's doing something impressive. Most people would probably think Jake made the better choice. But here's the first lesson. The best investments often look boring in the beginning. By the end of year three, Jake has collected about $64,800 in rent. His mortgage payments total around $47,880. At first glance, it looks like nearly $17,000 in profit. Then reality arrives. Property taxes, insurance, repairs, vacancies, maintenance, a water heater replacement, a roof leak, a tenant moving out, lost rent, cleaning costs, relisting costs. Jake manages the property himself to save money, but that creates another cost: time, phone calls, weekend showings, repair coordination, paperwork, stress. After all expenses, Jake's actual profit is much lower than it first appeared. The rent checks looked impressive. The real profit looks far less exciting. Meanwhile, Marcus has invested his original $50,000 plus monthly contributions. At roughly a 10% annual return, his portfolio grows to around $76,000. No repairs, no emergencies, no tenant issues, just compounding. However, Jake still has one major advantage: leverage. His property has appreciated and is now worth around $270,000 to $280,000. Because he used the bank's money, even a modest increase in property value creates significant growth in equity. That's the power of leverage. Most people expect one investment to completely destroy the other, but that's not what happens. Over the next 10 to 20 years, the gap becomes much smaller than most people imagine. The real question isn't which investment makes money. Both do. The real question is which path fits the life you actually want to live.